Be more than happy.
Would be
I'd like
interesting,
to
actually.
learn. I'd like to go out for a day and navigate. Yeah, not enough to
Yeah.
actually be helpful, but
Not enough to be helpful.
I should tell Bill he has to take us on a team building. sailing trip.
Okay. I think we're up to chapter 10. I got it right.
I wrote slide 37 is where we stopped. Did we start the
Okay,
recording?
this is 37. So
Did we start the recording?
we're recording.
Oops.
Expenditure recognition and governmental funds. Accrual accounting as expenses. And expenses recognized as soon as a liability is incurred, regardless of when the liability will be liquidated. For near-term liquidity, outflows that will not occur in the immediate future are largely irrelevant. Bonds payable, environmental remediation, pensions. Expenditures, as opposed to expenses, are recognized only at the point that liquidation of the liability normally would require the use of current financial resources. Modified accrual is modified form of accrual accounting, but modified cash would be a better description. In fact, when they came up with the term, they seriously thought about calling it modified cash, but there was some other system that was using the term modified cash, so they ended up with modified accrual. And then this one can be tricky, so you start to think that like any of your short-term categories of liabilities should be reported in modified accrual, but most of them aren't. It's got to be something that you owe the money and you're going to be paying it sometime in the next couple months. But even then, that's not a great description because you can have bonds payable or accrued interest payable that is going to be paid in July or August, but you don't record those. And it's kind of the problem I got with the short-term accounting that they're talking about going to, because it's tempting to say you just take all your short-term liabilities and short-term assets and transition them over to short-term accrual that they're going to be creating, but that's not what they wanted to do. I made that argument in my letter to them, but the flaw in my argument is that I was arguing from the point of view of basis of accounting, accrual accounting. You would think all those things would be in there, but you have to remember that measurement focus is where it tells you what you measure. So they can tell you to measure whatever the heck they want to measure by defining the short-term measurement focus. But then whatever they define as short-term measurement focus, then you apply the accrual based accounting to those items when you measure them. So anyway, that was the flaw in my argument. I knowingly made it anyway, just because it doesn't seem right to me. So anyway, but then that goes back when they had the invitation to comment. I testified in front of the board and said that all funds should be economic resource measurement focus and accrual basis accounting. And I think 20 years from now, next time they do a reporting model, that's where we'll end up. But for now, it's too big of a jump for most people. Expenditure recognition. In absence of an explicit requirement to do otherwise, accrue liability and expenditure in the period when the liability is incurred. So salaries, professional services, supplies, utilities, and similar items are recognized in expenditure in the period that the government receives the goods and services. So that's pretty much what we're accruing at June 30th. So what ends up in our accruals for payables at June 30th is anything that's basically in the AP system and in the process of being paid. But then we, as part of the June 30th closing, so we'll shut off SAP to everybody but a few people at 4 o'clock on June 30th. And then we go in and start doing stuff to close everything out. And one of the things we do is we run a purchase order report. And then the bureaus will take that purchase order report and go through and start estimating that, okay, this contract, we think they did this much work in June and they're working out with this much money. And they just go down, and that's what on the basis of their accrual entry they do in early July to pick up the rest of the accounts payable, basically, that isn't in the actual accounts payable system. So our exceptions are like debt service, pensions, capital outlay. Rather than depreciation or amortization, we have accrued interest expense that we don't recognize, compensated absences, termination benefits, pollution, claims and judgments, landfill, post closure, certain accrued liabilities, and prepaids. So prepaids and inventory are weird, and that inventory, we can either use the purchases method or the consumption method under modified accrual, and we use both. So for budget, we use purchases method, and for consumption, in the GAAP basis statements. And it's an interesting way that we do that. So the inventory accounts in the balance sheet start with 141. And there are a few of them. So in FI, the inventory balance is the actual inventory. Over in FM, it's just the change in the balance of that account during the year. If we draw down inventories, it's going to be a negative number. If we increase inventories, it's going to be a positive number. And then the way we accomplish recording that in the ACFR is that in our extract file for inventory, there's 2 lines, and one of them is the beginning balance, and the second line is the change during the year. So for our GAAP basis statements, we combine those 2 accounts, and then for the budgetary schedules, we just use the change.
Is there a reason we use the two different methods?
Well, you think about it from a budget development point of view. So in budget development, you're wanting to identify all the resources that you have available. So you start off with your beginning fund balance, estimate all your revenues for the next year, any debt, any proceeds of debt that you're going to get for the next year, any transfers from other funds that you're going to get during the next year. So you identify all those resources, and then you start figuring out how you're gonna use those resources, and then that's your appropriations. So since beginning fund balance is one of the resources you're gonna spend next year, you want that to be actually something you can spend. If you had inventory in there,
Mhm.
that's something that you can't really spend that. Similarly, for under,
Prepaids and prepaids.
and prepaid the same way.
Yeah, that makes sense.
And advances are weird. But, and then our mark to market, GASB 31, mark to market entry for investments. And then that's been modified by 74, I can't remember what number it is. But there's another GASB that talks about fair value and made some adjustments to that mark to market. But we don't recognize that change. So it's a balance sheet account for GAAP, but it's not part of our balance, our budgetary balance sheet, because who knows what the actual cash valuation will be. So we use actual cash, where in GAAP, we take actual cash plus that mark to market stuff to reflect the fact that our investments have gone up, value of them have gone up and down. And I'm trying to think which way it will be this year. So interest rates have gone up since a year ago. So I think that means our bonds are, is it less valuable or more valuable now?
I think less valuable.
Mhm.
I think less valuable
I think so.
because they're a set interest rate, so comparatively,
Like less valuable to investors,
it's valuable to investors because
not to
now they
us.
can get better returns maybe.
That makes sense.
You gotta pay less money for the bonds.
Yeah.
If it's
They'll pay less
cheaper,
for
if the bond has a 2% yield a year ago, and you can get 5% now, you're not going to pay the same amount. So it's our actual, we will be having a big hit to our.
Do we have to sell them at a discount
Yeah,
then?
within our pension liability, it'd be the opposite.
Yeah.
Yeah.
Because it benefits when interest rates are higher.
Yeah, so, anyway. So anyway, that's the reason, is we want that budgetary fund balance to be actually something that they can know that they're gonna be able to spend.
In other words, like liquidate and use it as a source of,
Yeah.
in their projections for,
So they'll be able to take the cash and receivables and pay the payables and whatever's left over the net, budgetary fund balance is something that they'll actually be able to spend in the next year.
So inventory under consumption method includes inventory from previous years, so it's not relevant.
I try to think about it as like, could I take this and pay a different liability with it? Like I couldn't take inventory and like liquidate it and pay it, so. When I
Yeah.
think about it, like in terms of like, is this an actual source? Well, could I take inventory and pay a phone bill with it? No, so.
Yeah.
It's not a source,
Yeah.
though it's an asset.
Anyway,
Interesting perspective.
that's why we have some of those changes. And then we do the wonky thing with our loans receivable. For GAAP, we actually debit loans receivable and credit cash. And it's an asset. But for budget, we go ahead and order it as an expenditure and credit cash. Because that loan receivable isn't going to be available just to buy anything in it. In the next fiscal year, and that wasn't a resource that's available. So, and that's how things are going to be in short-term measurement focus when we go to that.
In 20 years?
Hmm?
In 20 years?
No, that'll be 2025.
Oh, I'm so glad I made it to the recording. Which one was the one that you were saying wouldn't be for the one that you were
Going
suggesting?
economic resource
Oh, that's-
measurement focus and accrual basis accounting
For all funds.
for all funds.
That's right.
So right now we use that for proprietary funds, fiduciary funds, and government wide. But what they're trying to grapple with is what should governmental funds accounting be? So their proposal, it looks like, is going to be short-term measurement focus and accrual basis accounting.
Thank you.
But then you have to go and really read the standard and figure out what we're going to measure with short-term measurement focus. Is that, could they get to decide which assets and liabilities we're going to be measuring? And then once they make it, if it's in their list, then we apply the accrual basis of accounting to actually measure. Other financing sources and uses. So this is another odd aspect of governmental fund accounting, and for us, all of our funds for budget use modified accrual. So anyway, we're looking at things that are inflows and outflows of resources that really don't fit the description of revenues and expenditures. So proceeds of debt issuance, bond premiums, transfers in, sale of capital assets, insurance recoveries, and for budget under Oregon revised statutes or ORS. We're required to record payments and proceeds of internal loans in the flow statement. And then other financing sources and uses, bond discounts, transfers out, payoff of bonds for advanced refunding, and for budgetary internal loan remittances. Now, under the short-term measurement focus, one of the things they're changing is if they stick with what the plan is, there won't be revenues and expenses. There'll be inflows and outflows, and then they'll be segregating inflows and outflows by operating and capital. So, like our transfers out will be an outflow, and then we'll have to analyze those transfers out to figure out what the purpose of it was. If the transfer was made for operating purposes, then it would go in the operating section. If it was made so the other fund could buy capital or build something, then it would go into the capital section. And similarly with bond proceeds and transfers in, those will either be inflows related to operations or capital. Which is different, but I kind of like the moving away from revenues and expenses to inflows and outflows. It's kind of what we do now in fiduciary funds, where we do additions and deductions. But they've been moving towards this for a while, of thinking about it in terms of flows. So we've already got deferred inflows and deferred outflows, and now we're going to have inflows and outflows. So that's just part of the conceptual model that they're trying to build for this. Assets and liability recognition and measurement in governmental funds. So assets, we got cash, investments marked to market, property taxes receivable, other receivables, assessments receivable, loans receivable, Now, like I said earlier, for budget, we don't put the loans receivable in their budgetary assets, but we do for the GAAP assets. Inventory, again, for GAAP, we have inventory. For budgetary assets, we don't have inventory. Assets for resale, internal loans receivable, again, just for the GAAP, because and under our ORS, that is inflows and outflows, so it doesn't show up in the balance sheet for the budgetary basis. Advances and prepaids and due from Prosper Portland. And that's always one of our messier issues, is Schedule 31 or something. Because our AP and AR system, for some reason, isn't sophisticated enough to clearly define our receivables and payables with Prosper Portland. So we rely on them to tell us. And then they'll start playing games. They'll decide, well, we don't really want to recognize that expenditure, that revenue, so that then they'll go in and change the due tos and due froms. On our side, we don't actually make any changes to expenditures and revenues related to that. We're just, so here due from Prosper Portland is buried in our accounts receivable. So we just reduce accounts receivable and increase due from. And similarly, over on the liability side, we'll just reduce accounts payable and create the due to Prosper Portland. So we're not hitting our flow statement when we do that, but Prosper Portland seems to do that. Because they're taking around with their budget recognition. So for liabilities, we got accounts payable, internal loans for GAAP statements, not for budget. Advances on contracts where we haven't earned the money. So unearned revenue, approved payroll, due to Prosper Portland and due to FPD&R. So FPD&R is an interesting one. So in the day-to-day operations, we record the tax receivable associated with FPD&R and FPD&R, but technically that receivable belongs to the general fund. So one of the things that we're doing in general fund, when we're setting up the GAAP basis statements for general fund, not the budgetary ones, we add that receivable that is on FPD&R books, and then set up a due to FPD&R. And then we also debit employer contributions, but basically personnel costs, and credit revenue for whatever their taxes revenue in FPD&R was. Because technically those taxes should have been deposited in general fund and then paid over to FPD&R as part of their pension contribution for the sworn officers. So when you look at like public safety costs and tax revenue in the GAAP basis statements are way different than in the budgetary schedules, because for budget, we record all that revenue and expenditures over in FPD&R, not the general fund. But we do have to include it in the GAAP. So just some of the weirdness of how things work. Let's see. Check, see if I didn't. Okay. So governmental fund financial statements focus on major funds. And the funds, in order to be made major, need to be 10% of the governmental or enterprise and 5% of the total. And we're looking at assets plus deferred outflows, liabilities plus deferred inflows, revenue, expenditures, and expenses. And each major fund has to have its own column. And then the rest of the funds are just a total other funds. And we test this multiple times through the year, just to make sure that something hasn't become a major fund. So, and then we can also choose to make something a major fund. So right now, the grants fund tends to pop in and out, depending on how much grant activity we have. Lorenzo actually did this
Yeah, I think this
recently,
year,
so he's familiar, but
this
everybody
year,
else's perspective.
this year as of last month, AP9, it is still major.
So
No, not anymore.
what we're doing is we have a column for each fund. And what are the deferred outflows plus assets? And deferred inflows and liabilities, revenues, and expenditures. So general fund is just automatically always a major fund, regardless of anything. In every other fund, what we're looking for, this is telling us that 281 million is the total, is 18% of the total governmental fund assets and deferred inflows. And then you go down and you add the enterprise funds. And it's the next number saying that it's 4% of the total. And then liabilities, we do the same analysis, and revenue, we do the same analysis, and expenditures, we do the same analysis. So, since here, if any one of these
Yes.
triggers it, so if any, and for any one of these, the category is 10% and 5%, then it becomes a major fund. So down a little bit.
217.
So Fund 100 through 500 are governmental funds, so we have 1.5 billion in assets. So that's what we're testing initially is the fund's assets at least 10% of this. So all we're doing here is taking whatever the fund's total assets is divided by the total assets of all the governmental funds. Over here, what we're doing is taking the fund's assets more than 5% of the 1.5 billion of governmental fund assets, plus the 5.8 billion of enterprise fund assets. So we're doing that for every fund. And so for governmental funds, we're comparing 10% of governmental fund totals and 5% of citywide. And when we go to the enterprise fund, we're comparing 10% of the enterprise fund total and 5% of the citywide total. And then that tells us which of our funds is major, so. Water and BES are grants, general fund, and Vaught end up being our 5 major funds.
Can you scroll down just one? I was curious about this one. It says yes, and it says 3 and 3. Is that just for this, the number 4, or is the, oh, I see. So that would be just for expenditures, not as.
So it can be of any category. So if you look over,
Gotcha.
it'll be liabilities.
So it's this
So
guy
it's
here.
46 and 5.
That's what's causing this.
Yep.
Okay, gotcha. Thank you.
And for the grants fund, that's because unearned revenue, is we got ARPA. And I can't remember what year this is, but anyway, both last year would have been ARPA unearned revenue related to that, and the prior year it was unearned revenue related to CARES.
So again.
So I've always thought it really should be at least 2 of the categories that it meets.
But in the year 2019, grants is still not a major fund, right?
2019, it wasn't.
It was
2020 is when we had the CARES money,
right.
and it was in 2021 was ARPA, and it is in, and then this year,
Yeah.
we're gonna get another $100 million sometime in the next week or 2.
Okay.
So it'll be a major funding in this year. So now, from an audit perspective,
Yeah, that's what I was just about to ask.
um,
What are the audit implications of that? Because don't they have to like rotate which funds they audit, but then they also have to look at like, there's some sort of calculation or something that they do, like a certain
that's how we do
percentage.
that, the single audit,
Oh, single audit.
and we'll get to that, but here.
Hi, Ron. Are you
Yes.
sharing your screen? Because I don't see anything. Just see the slides.
It may not have grabbed it when I opened up the spreadsheet.
Okay.
We can unshare and then reshare again,
Is that what?
Yeah, thank you.
or we can just go back to the slide.
Oh, sorry. Oh, were you done with this? Were you gonna
Yeah.
switch back to the slides?
So that audit perspective is that the auditor is giving an opinion on opinion units, which is weird because like when I was in school, you couldn't do a piecemeal opinion, which just always felt like a piecemeal opinion.
Right.
So they're giving an opinion on each of the major funds, so that's 5 opinions. And they give an opinion on the government-wide. That's 6. And then they give an opinion on everything else. So 7 for us. And then everything else includes like no disclosures, and it's just weird. And at some point we'll get to. There's a spreadsheet that runs through that and figures out materiality, and we'll talk about materiality, bring that up, and it'll make a little bit more sense as to what the opinions are. So statements on governmental funds, we've got a balance sheet. assets and liabilities that represent current financial resources and obligations. Fund balance has to be broken down by non-spendable, which is our inventory. And then for permanent fund, so the permanent fund is where somebody gives us money and says, you can't spend this, but you can spend the interest you earn on it. So the corpus, that original amount that they gave us is non-spendable. And then we got restricted by external limits. So this can be like state law or a bond covenant or a ballot measure. Something outside the city has said you have to spend the money for this specific purpose and you can't spend it on anything else. Committed is basically something really similar, except the city council does it. So they come in and say, you can only spend this revenue stream for this specific purpose. And we've got a few instances of that. That they could do it with any revenue stream they want to do it with. And then we would have to move it into a special revenue fund. It can be in the general fund.
Good question on those. How is compliance with those restrictions maintained? Like, is there somebody, is it just like within the department who's spending the money, or like if it's restricted, for example, by law versus like by ordinance? How does that
Okay.
get tracked?
So we do it by fund accounting.
Okay.
General fund is just kind of what it says. It's general stuff. It's revenues that can be used for anything. Special revenue funds, and they're kind of, I think they're changing the name to special finance fund. They may have already done that already, but I always think of it as special revenue. So it can't be a special revenue fund. And actually this. It can't be a special revenue fund unless it has restricted or committed revenues.
Okay, thank you.
This is just our spreadsheet. And then we got debt service funds. That it has to be used for paying debt. And for us, most of those, the revenue that comes into that is restricted, like urban renewal districts. And then we got capital project funds. And that can be restricted or unrestricted, really. There's just a multitude of revenue streams that will flow into those. And the permanent fund, which, like I said, is where we can't spend the corpus.
Mhm.
And there's enterprise funds and internal service funds, trust funds and custodial funds. But that's kind of how we keep track of it. And we'll put it over into a special revenue fund if it's committed or restricted.
Okay.
And then you're isolating that money,
Mhm.
and then you can go ahead and audit it, and you can say, okay, yes, we spent it for the purposes, or didn't spend it for the purposes.
So by virtue of its classification, it, like the nature of it kind of is acts as a control.
Yeah.
It's interesting.
So this is how we break down. So we had B54 is what created these different fund types. We had something totally different before that. But, on the face of the statements, you're allowed to summarize it and just have non-spendable or restricted, committed, assigned. But you have to then, in your note disclosures, really slice and dice it. So here we're showing, like, for non-spendable, This is how much is inventories, this is how much is prepaids. And this is how much is our permanent fund. Now, this one is an odd number because in reality, that is $119,000 worth of cash that's sitting over in the police department for drug buys and informants and that sort of stuff. But we call it prepaid just because of.
Because it looks bad to say drugs.
Slush fund for.
Our slush fund for
Right.
code.
Police operation.
And then we have
Inventory.
restricted and then we have to do it by type and then breaking it down more.
Mhm.
So this is another schedule somebody will have to do. And this is setting it up by those major funds, so general transportation grants and then all the rest of them. And then we just slice and dice it down to a more granular level.
We might want to fix the screen share. There's no red border, so we can tell it's not showing in the Teams presentation.
And
Oh, can Svetlana click on the link and would that work? Is that how you accessed it?
that's how I access it.
Oh, I
I-
just tried and it didn't work. Oh, wait.
Somebody else needs to drive it.
Oh,
Couldn't accomplish that.
yeah, Svetlana, you can, if you wanted to look at it, if you're,
Go into the president's presentation
oh, I have to
on Ron's mouse.
on our.
What was it?
Showing up in the recorded presentation either, so we should fix the screen share.
Do you want me to fix the screen share for you, Ron? I can take the mouse.
So hopefully they're gonna get this camera.
That way,
There you go.
now it should show everything, even if you open something else.
Okay. So statements of. Get rid of this. So flow assumptions. When a fund has revenue streams, which are multiple constraints, we assume that the restricted revenue is spent first and committed revenue and finally assigned. After the balance sheet comes a reconciliation between the governmental fund balance and the governmental activities net position in fund balance and government-wide statements. Then comes a statement of revenue, expenditures, and changes in fund balance. And presents the revenue by major source and expenditures by function. And finally, a reconciliation between the change in governmental fund balance to the change in net position. So let's try this again. See what happens. So that's our balance sheet. And again, we got major funds and then the total of the other funds that aren't major. And we break down our balance sheets by unrestricted and restricted. So that's part of the presentation entries that you'll be doing in July and August. It's to get this presentation because everything starts out, cash is just cash. But we have to calculate how much is restricted and then do a presentation entry to move it to the restricted portion to restricted. Similarly with liabilities. And then for deferred inflows, basically that this is that deferred revenue or unavailable revenue. That's basically that the receivables that haven't been collected within the first 60 days of the next year. And then our balance sheet is broken down by the types of fund balance. And so our ending fund balance over here is $1.2 million. So in a reconciliation, we start with the $1.2 million. And then we start adjusting that for all the differences. So capital assets. And then deferred items. And then the balance is internal service funds, because internal service funds are part of governmental activities. Talked about at one point where. Since they primarily serve governmental funds, we blend them with the governmental activities rather than business type activities. And then we subtract out our bonds payable and our pension liabilities. And in this -2 billion is our net position for government wide. And similarly, we have our operating statement. And we're doing this by function, so public safety, parks, community development. And our other financing sources and uses. And again, this is our change in fund balance, so we bring that down here as a starting point, and then we go through all of our adjustments to get our change in net position for the governmental activities. And similarly, we got water funds and sewer, water, and other funds, and then internal service funds over here for our proprietary funds. And this is basically the what's called the look back adjustment. So basically it has to do with the internal service fund activities related to enterprise funds. And then this adjusted is the net position for business type activities. And operating and non-operating. And then again, we have just this one reconciliation between fund change and net position to business type activities changing. And we got the cash flows. And when we get there, we probably should have Melina teach the proprietary fund section of it.
Maybe next year.
Okay, statements for governmental funds. We do eliminations in the general fund for interagency activity. So the police department will pay the city attorney for defending them in cases. And we have to, for cash basis statements, we have to eliminate that money that's just going back and forth between the general funds. But for budget, we don't do the eliminations. Yeah, let's try. Okay, there we go. Investment income and loss is one instance where an operating statement line item may be negative. So, like we discussed it earlier, we make a mark-to-market entry this year will probably be negative, so it's conceivable some funds will end up with negative investment earnings. The budgetary schedules for general fund and other major special revenue funds appear in RSI, so required supplementary information following the note disclosures. So for those, we're required to have the original, final, and actual, and a variance. And then in all RSI, we can only include what GASB says. So it's both the minimum and the maximum. Now, one change to that they're talking about in the new model is for some weird reason, they want us to add a column that says how much the budget changed from the original to the final. So that'll be an additional column.
What's the benefit of showing that?
Yeah, don't we already have that?
The changes, I think we are starting in the budget, right?
File it and see what, yeah, it did change. But
How much?
for some reason, somebody wants to not have to do the math themselves. Like,
Me too.
You do it for me.
Is it the one that is similar to what we are doing in Schedule 56?
Yeah,
Right,
so in Schedule 56, that is.
Like,
the
from
schedule.
original budget, then we have the fall, and then the spring, and then the OEO.
Yeah, but it won't be to that detail, it'll just be the total. But for 56, we want to be able to, for the auditors want to be able to see, okay, this was the fall bump, this was the spring bump, this was the OEO, and then there's a grant column, I think. So they want to be able to see it. And then I also use, I have to do some explanations in the management discussion and analysis of why the budget changed.
Okay,
So for general fund. So I do use that. And then there's Schedule 70, which we prepare for the auditors, which is basically that where we take the beginning budget and the ending budget. And if the delta is above a certain level, I think it's usually $1 million or something. Then we have to send that out to the bureaus, and then they have to write an explanation of why it changed that much, and then that goes to the auditors.
explanation of significant variance.
Yeah,
No, we get,
I did that when I was an auditor, but I really never understood why, because basically it's always, well, I planned this, but that's
Yeah.
not the way the plan works. So,
right,
You know.
Right,
and that's generally what the explanations are.
right.
It exploded. That's the
The
term.
pistachio.
But it's just, and in the program that they're working from, that's one of the steps, so they have to do it.
Oh, yeah.
And
I hated being that person as the auditor. Like, I'm so sorry, I have to ask.
I noticed they didn't change their benchmark, like it's always
Kind of
20,
the same year to year.
yeah, it's year to year, they didn't change it. Is it because our budget is kind of constant or?
it's got to be based somehow on their materiality, and the city is growing over time, but not major changes, so.
Other major changes.
It's usually like $1 million and 10%
Okay.
change, so. Like property taxes might change by 100 million, but it's a 1% change, so, they don't need that explanation.
Some ones have a different threshold. If it's a larger fund, it'll have a different threshold.
Yeah.
Smaller ones.
And that's kind of and then you can kind of see it too, because they give us those numbers. And sometimes it's a clue to which funds that they think are a risk, because the difference between what they're using in the threshold doesn't really make sense in relationship to the size of the fund. But somehow they're doing a risk analysis and deciding some funds are riskier, and they will lower the threshold. So it's kind of a clue as to what their risk analysis was. So proprietary funds, enterprise and internal service. GAAP basis statements use economic resources measurement focus and accrual basis of accounting. Statements are the statement of net position. We've got a statement of revenues, expenses, and changes in fund net position. Then we have cash flows. Enterprise funds are providing services to external customers and trying to cover the costs of services and revenue bonds. So that's kind of in the definition. So the way it's set up is if a fund issues revenue bonds, it is automatically an enterprise fund. But if it doesn't have revenue bonds, it may still be an enterprise fund if you're wanting to provide service to external customers. And sometimes you cover costs of services. So I audited a aquatics district that had no revenue bonds. The fees that people paid to swim and get lessons didn't come close to paying the cost of operations because it was primarily funded by property taxes. But we kind of wanted to, or they kind of wanted to measure things like an enterprise fund measures it. So we set it up as an enterprise fund. And TriNet might be similar to that. They probably have revenue bonds, but I think the tickets don't come close to paying for the cost of operating Metro. I guess primarily taxes and grants. So anyway, if it has revenue bonds, it automatically becomes an enterprise fund, but we have flexibility if we wanted to call something an enterprise fund, but we could just make it an enterprise fund. Internal service funds are providing services primarily to internal customers. We're trying to cover cost of services on a cost reimbursement basis. They should not be building up significant reserves beyond what is required for good management. The goal is to break even over time. And then there's a look back adjustment, which is basically when we're doing the government wides, we're flushing out any profit or loss that they made in a given year. And then we have a bunch of them. We've got the health insurance fund, fleet facilities, workers' comp, liability insurance, P&D, BTS, and there's the weird one for the police union health insurance, but I never have figured out exactly what that is, but it has something to do with their union contract. Now, you don't have to have internal service funds. Michelle said that like Phoenix, which is bigger than us, doesn't have internal service funds. And if you don't use internal service funds, what you basically do is you run all this through the general fund. So issues that you come up against with proprietary funds, capital asset impairments, bond refunding, fundings current and advanced, compensated absences, system development charges, developer contributions, and regulated industries. So SECs, we have those, both in governmental funds and enterprise funds. And those basically are, if you're building a house or building an apartment building or office building, as part of your fees, you will pay BDS a certain dollars based on the cost of the construction and probably type of construction. I don't know exactly how it's calculated, but and then that money will go to parks and PBOT and BES and water. Oregon has two types of system development charges. And we use both of them. So BES and water, when you pay an SDC, you're basically buying into the existing system. So you're theoretically paying for part of the your share of the cost of the current wastewater treatment plant and the current pipes in the ground and all that sort of stuff. But for PBOT and parks, your SDC is buying something that is going to be built. So if you are building out in southeast Portland, that money is supposed to be accumulated to put in a park in your neighborhood or to do sidewalks in your neighborhood or some project in your neighborhood. So you should be getting something new related to parks and transportation, where with water and BES, you're just buying into the existing system. Developer contributions, we've talked about that before, where the developer finishes builds the subdivision and gives us the sewer lines and water lines and streets and stuff. We're kind of out of time, but next time we'll talk about refundings. Understanding the difference between current and advanced refundings is useful. And capital asset impairments, that gets complicated. So anyway, we'll pick up with number 50. That's fine.
A third of the way there.
Huh?
A third of the way there.
Yep. Through this slide deck. I'm already starting on another one.
Oh, yeah, and the recording. Yeah, it's the 3 dots more. And then the red button, yeah.